Great. Hello, everyone. Look, thanks for joining. Um, Sorry for a little bit of delay as we just got everything set up. Um, but we're going to jump into a bit of an introduction to carbon accounting. In just a second, we'll wait for everyone else to get in. Um, Great to see everyone joining. No, certainly most of you who've joined. Um, yeah, really keen just to strip everything back today. So everyone get your most basic questions ready because there is no simple question today. We really want to approach carbon accounting at its most basic form, which we will cover off in a second. I know as well, having come into this industry like 2.5, 3 years ago now, a lot of the time you can really just have these concepts or terms that have just been thrown around in the everyday vernacular so often that you have one perception of what it means and it might actually mean something else. And first one that kind of comes to mind always is the difference between carbon neutral and net zero, which we're going to cover off. But we'll just wait another minute or two, and then we'll be good to go.
Fantastic. And Alex, I'll be handling all of the questions in the chat, and so if anyone has any questions, please put them in the chat. I'll make sure to prioritize them and feed them through to Alex at the right points throughout the webinar and also towards the end. And also all the newcomers, I'll be able to look after them and make sure that they're up to speed. So, Alex, I think we're good to go whenever you are.
Yeah, awesome. Great. I'm going to share my screen. We'll go through. Awesome. Everyone can see that.
Yep.
Great. Cool. So, look, welcome everyone. Again, look, as mentioned, for those that just joined today, we're really going to strip everything back and just look at carbon accounting from its most basic form. Like what is it? Why are we doing it? Why is it important? Where does it fit in this broader sustainability piece? And then kind of understanding how it works a bit more. I think this really helps when taking into account, what your company or what your role potentially in a company is when it comes to carbon accounting and what's it all leading to. And I think the first step as well, to kind of before we jump into that, is a bit of an introduction to NetNada. Um, Nearly everyone here has had something to do with NetNada in some space, but what we do and what we offer in our tech at its most basic form is a carbon accounting platform. We obviously offer a lot of sustainability consulting, a lot of, assistance and certifications or whatever it may be. But what our system is doing is calculating your carbon emissions. And so, some of the clients we worked with and wanted to kind of take a bit of a step back and a broader approach to why carbon accounting is important and why it is something that, companies from 2 employees, 1 employee to the largest companies in Australia and around the world are all kind of thinking about and talking about at the moment. And at its core, climate change, and we'll talk to some of the, historical movements that took us there in a second, but climate change and us, preventing the warming of the planet and the impact that that brings and the risks to business and society and people as a whole is inextricably linked to the reduction of greenhouse gas emissions. Now, what carbon accounting is the calculation of greenhouse gas emissions. So, big thing that we've kind of always spoken, you may have heard it across a number of different areas, but you can't reduce what you can't measure. So, the first step for us to reducing the carbon emissions, the greenhouse gas emissions around the world or, globally, and, bringing us down to this level that we need to be by 2050 is to calculate them. So that's why carbon accounting has become, such an important part, of business in this sense, because it is what is going to allow us to avoid a lot of these risks and become compliant as, the world changes. And compliance and as the world changing is, I think it's good to kind of look back as to some three big moments, I'd like to point out since when carbon accounting really came into effect. And the first one was 1997 in the Kyoto Protocol, and that was ratified. And that was essentially the first big, commitment by the UN and by, a number of international states to reduce carbon emissions, to understand that, we need to um, create a global standard for calculating so that we can then look to reduce and measure. And that's where the creation of the GHG protocol came into account. And if you've done anything with NetNada, or if you're working with any reputable carbon accounting service or consultant, you'll always kind of hear this mention of alignment with the GHG protocols. And if you look at the Fortune 500 over in America, it's like over 95% of them, how they're calculating their emissions are with and align with the GHG protocols. And that's what was kind of born out of this Kyoto Protocol in 1997, saying, okay, we need a standardized way of calculating so we can all figure out how to reduce these emissions and how to calculate them best. Fast forward to not much action, to 2015, the Paris Accords, 2016, 2015 is a big moment when all of these UN participating, aside from a very small number of countries, committed to reducing greenhouse gas emissions, to getting us to a target of below 2 degrees or well below 2 degrees global warming over the next period of years. So we've got this calculation of we need to reduce commitment. Greenhouse gases are bad, to an actual target in 2015 from various states. It's taken a while. Fast forward 7, 8, 9 years later, different countries, and Australia's certainly lagging behind. But now, across pretty much all developed OECD countries, we're seeing these mandatory reporting requirements coming into the private sector. In Australia, it's been pushed back a little bit from January 1st, 2025. It's going to be mandatory for companies over 500 employees to calculate and report their carbon emissions. The next year, 250, the year after that, 100. All of a sudden now, carbon accounting, the process of calculating our carbon emissions, is everywhere if we want to kind of reach this level of reduced greenhouse gas emissions to keep our planet in line with these science-based targets. So that's the kind of the history that led us here, why it's important, why we're kind of seeing it everywhere. In Australia, the kind of greater sustainability landscape, we have that consultation paper that came out back in the last year. Just in August, we kind of saw a bit of an update to it around that mandatory reporting requirements. We're seeing, this flow into things like government procurement. If many of you may have seen in tenders, or if you're going for grants, there's now requests as to what your carbon emissions are. And then this is flowing on to more of the industry-specific legislation. So global changes leading to country changes, leading to industry changes, and all of it's kind of really pointing to this increased requirement for carbon accounting. But in the saying that, and as I mentioned before, some of us got on, it's like, okay, what is carbon accounting? What is carbon neutral? What is net zero? What is scope 1, scope 2, scope 3? Some of these things, it feels like we're just expected to know, but they haven't really been around for that long. They certainly haven't been existing beyond, environmental scientists for that long. So we wanted to really just explain and break down some of these terms, and chuck any questions you may have in the chat, and we're going to go through them all and kind of look at some basic ways of how carbon emissions are actually calculated, rather than just uploading your data into a system. But first one here, and this is a really kind of big difference, or something that some people find themselves getting into a pretty common trap: the interchangeable use of carbon neutral and net zero. Now, carbon neutral is when you calculate your carbon emissions and then you offset them using carbon credits, which we'll explain in a second. Whereas net zero, and there's a number of different varying definitions of how it works, but at its most basic form is that you are emitting zero greenhouse gas emissions, or emitting the zero possible. You've reduced or removed, without offsetting, the total possible greenhouse gas emissions. Now, net zero, no one is really achieving net zero at the moment. It's not necessarily possible at the moment. So that's why sometimes people are kind of going out making these claims, we're going to be net zero by 2025, when really they mean carbon neutral. Luckily, it's a pretty common mistake, and therefore no one's really kind of enforcing it unless there's, that top level. But there has been, that kind of greenwashing level. Some of these larger companies who are very sophisticated, who have a lot of understanding, and they have, teams and teams of consultants making these net zero claims that probably they're not going to be able to uphold. talked about carbon accounting. One thing you'll notice here, and you may have kind of seen, okay, well, what is the CO2e? And, carbon emissions and greenhouse gas emissions, are they the same thing? Greenhouse gas emissions is actually more than just carbon. Carbon is the main greenhouse gas, but there also is methane, nitrous oxide, there's water vapor. What To simplify things rather than kind of mentioning, the different variations of which element we're referring to, is that it's all being collapsed into a carbon dioxide equivalent, so CO2e, and hence why we just refer to it usually as carbon emissions. And I'll have a bit more on that in a second. But GHG protocol standard, we mentioned that, this is classifies the greenhouse gas emissions into scopes. It's been around since 1997. It's what any good carbon calculation will be looking to align with. You have your scope 1, your scope 2, and your scope 3 emissions. Now, scope 1 is your direct emissions from owned and controlled sources. This is the official definition, but an easier way to understand is things like your fuel, any refrigerants. But the fuel is the main one from owned cars. Now, your scope 2 is your indirect emissions from purchased energy. This is your utilities, your electricity, your gas. Everything else essentially falls into your scope 3 or your value chain or supply chain emissions. Now, this diagram is a very, very commonly used diagram. It's from the greenhouse gas protocol standard. And you can see here, it kind of gives some categories or examples of scope 3, scope 2, scope 1. So we can see here as well, what it's kind of breaking into are all the different greenhouse gases. But again, as mentioned, we just classify them usually as a CO2e. Purchase goods and services, again, as the name suggests, they do get into a little bit more kind of complicated, but the best way to think about it is how I just explained. This is carbon accounting 101, not advanced carbon accounting, is that your scope 1 is coming from your company vehicles and your fuel. Your scope 2 is your purchased electricity, steam, heating, cooling, your gas, and then everything else in your supply chain, all the expenditure of the business, the impact of the business is coming in your scope 3. And that's why your scope 3 is very important, because it is everything else. And, you may be thinking, well, I'm a professional services company, or I'm a company that has 4 employees. We don't have a company fleet. We're in a co-working space, or we've got a very, very small scope 2 footprint. Well, most of my emissions are going to be in scope 3. And the answer is yes. Like, we see hundreds and hundreds of businesses, and generally, it's 90, 95, 98% of your carbon account is in your scope 3 emissions. So that's why it's very important now. And this has really kind of changed in the past 2 to 3 years. Previously, there wasn't an expectation to reporting your scope 3 because it is quite difficult. It was around your scope 1, your scope 2. But now it is arguably the most important scope, with the majority of emissions coming from there, as mentioned. So you also see some upstream and downstream. It is very often just commonly grouped into scope 3 emissions, but you can kind of see here some of these definitions, and we'll send these slides around afterwards. Lockie, did you have anything you wanted to add to the scope 1, scope 2, scope 3 definitions? Because it is one of the most common ways of categorization, and people, I know I was when I first was introduced, it was like, that's kind of an interesting way just to break it down from fuel, electricity, and everything else. But yeah, look, did you have anything else to add to that?
No, I think you've done a really good job, Alex. The big takeaway here is knowing that you're a part of all of your clients' scope 3, and all of your suppliers are either a part of your scope 3 or your scope 1 and 2. And remembering in your scope 3, there are such things as upstream and downstream scope 3 emissions. So you could have a downstream impact of your product or service as it gets used, and then you can have upstream scope 3 impacts of your suppliers. So there's some slight variables and differences within scope 3 itself, but we'll get to all of that later on as well.
Yeah, great. So how do we calculate this? What are the carbon accounting methods that lead us to understanding what your scope 1, your scope 2, and your scope 3 emissions? So as some of you understand, and some of you are understanding, this is a difficult process to really understand across a whole business. Where are all the emissions coming from from each of these individual categories. And it's why, it's important to understand that carbon accounting at its beginning is not like traditional accounting, as in there is a single source of truth, 100% accuracy, correctness when it comes to doing this calculation, because there's different methods and there's different accepted methods for calculating your carbon emissions for different categories. And I'll explain what that means, in a second. But two of the main ones is around the spend-based approach. So this is worked by multiplying the product's value by its life cycle emissions in accordance with environmentally extended input-output model. We're going to break that down a bit more simpler, but emission factors, which we'll touch on as well, are used with either spend-based dollars or activity-based units. So how we calculate your emissions is by taking either the dollar spent or an activity, a kilometre travelled, a flight taken, a litre of fuel used, and then multiplying that by an emission factor. Now, emission factor is an accepted calculation for this input. So we could say that 10 litres of fuel spent may equal 50 kilograms of CO2e based on the emission factor. So the spend-based approach, as we touched on before, does have its strengths and weaknesses. Now, this is one of the simplest ways to get full coverage of a carbon account. So it's to look at all of the transactions, all of the expenses across a business, and then input all of those transactions into accepted emission factors. And this is what the NetNada system does, is very quickly analyze and allocate all of your expenditure into systems. But previously, without the use of technology, people would do this on an individual line-by-line transaction level. So this approach, again, uses benchmarks, averages, and assumptions based off available data. Then there are a number of different emission factor sources that can be used when using the spend-based approach. And generally, they are kind of location-based, like the Australian greenhouse gas factors. We can use the Climate Active, which is the Australian government certification, multiple different sources, but generally what they're then used for is allowing us to process a high volume of transactions and multiplying it against, a set of accepted emission factors. And straight away, we can kind of see some weaknesses that comes with just using a spend-based approach. We're using assumptions, we're using industry benchmarks. How do we know that $1,000 spent in professional service, with one company is an accurate reading when that company could be much less sustainable than the other? Or how do we know that we're just spending on a more expensive service than on something that was cheaper, and therefore with a spend-based approach we're seeing higher emissions? And the answer is, as I was mentioned before, this is how to get a broad coverage on our first initial point of carbon accounting. Can't expect to immediately know, unless you're using certain services and delving a bit deeper, the difference in carbon emissions from $1 spent at one company versus $1 spent at another. But this is a spend-based approach, is the first step generally in a carbon account, and is in line with the GHG protocols. Now, what we layer on top of that is activity-based analysis. And most people will use a hybrid, so they'll use spend-based and activity-based. And I wanted to kind of use 3 examples to show where activity-based analysis leads to a much more accurate carbon account than just using spend-based. There's electricity, waste, and flights. So with electricity, if we were to scan all of your spend-based data in your business and just use this spend-based analysis for your electricity transactions, we may see that you're spending $3,000 at Origin Energy. Now, using activity-based analysis, uploading your invoices or reading your invoices and understanding what the kilowatts per hour is used gives us a much more accurate reading. Now, we may see from that you're drawing energy from solar, that you're actually have a really good power purchasing agreement or an expensive power purchasing agreement. That means that the kilowatts per hour used are much lower than what the dollars spent suggests. And it's the same with flights. $5,000 spent in your account transactions on Qantas could mean one flight, business class flight, or it could mean 10 to 15 different economy flights. Obviously, the 10 to 15 economy flights has a much higher carbon footprint than the one business class flight. So layering on top, you know, because we do have coverage. If we analyze all the expenditure in your business, we would have carbon emissions for electricity. We would have a carbon emissions for waste and recycling, for flights. But it's then, okay, and how do we enrich this? How do we get a better reading, a better analysis? And this is what larger companies have been doing for a long time. It's like they're from their first carbon account to their, the one they've done, their fifth or sixth, the granularity of analysis has really improved. And this is what I meant when I said it's not like traditional accounting when you just, we know to balance it out and it's the exact readings the same. So we may over time improve from spend based to activity based to getting better emission factors to going out. And if you come along to our other webinar we're holding next week around supply chain engagement, getting individual supplier data rather than using an industry wide analysis. That's about as technical as it's going to get today. Obviously, we know we do need to get into the weeds a little bit on carbon accounting, but there are a lot of methodologies, and we're not going to cover everything you need to know in this one session today. We are hosting another carbon accounting 101 in 2 weeks, and I'll touch at the end there what we're going to cover in that because it's going to be a little bit different. But again, just understanding about how we take all these data points and then align them and attribute them to an emission factor, and then that leads us to an analysis. But again, one of the biggest questions and, one of the most commonly mentioned concepts when it comes to sustainability or carbon accounting is around offsetting and carbon neutrality. So wanted to touch on that a bit and cover off some general questions we get with that. So carbon liabilities is a term that you may hear. Again, this is very much embedded always carbon accounting in accounting terms, but carbon liabilities is synonymous with the CO2e emissions of a business. And this is where we really need to kind of think about your carbon emissions are potentially what's liable for what we need to reduce in the future. And when we're getting to these larger companies who've made commitments to offset all of their emissions, it does very much become a financial consideration because they may have 1,000 tons of CO2e that they now need to offset. That's a liability on their balance sheet. Carbon offsetting is leveraging sustainability initiatives such as wind farms, such as reforestation projects that reduce, remove, and avoid greenhouse gas emissions. So the reduction, the removal, the avoidance of a greenhouse gas emission is generated and turned into what's called a carbon credit by a certifier. Then these carbon credits, which we hear all the time, can be obtained and traded. And in fact, in Australia, ACCUs, which is the Australian Carbon Credit Unit, is a financial product that is traded. And a lot of people are making a lot of money of them at the moment, but they don't need to be retired straight away, is the point I'm making. So if you had 1 ton that you wanted to offset, you would need to purchase a project of reduction, avoidance, or removal. And then, it needs to be actioned by the official government programs like the ACCU. So again, how do you offset? You always hear this term offsetting. If you have 100 tons, for the example, you'd need to, and you wanted to become carbon neutral and obtain 100 tons of offsets, you buy 100 carbon credits, you retire 100 carbon credits, and then that's 100 tons offset. And if you've offset, as you remember from our definition at the start, if you've offset all of the carbon emissions for that period, then you can claim carbon neutrality for that period. Again, another interchangeable term that's thrown around all the time, projects versus credits. So the project, may be producing thousands and thousands of credits a year, or it has already produced thousands and thousands of credits, but the credit itself is an individual. It always refers to a ton, a carbon credit. So purchasing that from a project is how the separation generally occurs. Carbon offsetting scrutiny, it would be remiss of me to mention carbon offsetting without kind of touching on some of the news and general sentiment in market around carbon offsetting. So there was this kind of landmark report that came out in 2023 and was mentioned in 2021, 2020. And a lot of times people refer to this and they say, well, aren't they all just kind of, phony or fake? And it was this big report around a lot of these kind of rainforest offset credits. And there has been a lot of scrutiny as of late, and there has been a lot of really hard work in the industry to make sure that carbon credits are satisfying some of these major key points, additionality, they are additional. They weren't or previously kind of existing, have been quantified correctly. There isn't any leakage or, carbon isn't, when it is removed or reduced or avoided, it is permanent. And the vintage is not too old, and there are some co-benefits to consider. But some people are avoiding or moving away from carbon offsets for a number of reasons. Now, carbon offsetting is good. There's a lot of impact you can do, and you can reach carbon neutral, and the benefits of that is a different conversation. But not 2 days ago, but very recently, Telstra ditched carbon credits. And there's a number of consideration as to why they did that. But their official stance was that they wanted to focus more on the reduction of their carbon emissions rather than just purchasing credits. Because for a company like Telstra, they're looking at tens of thousands of carbon tons, even hundreds of thousands potentially. And every year, to remain carbon neutral, every year you would have to purchase carbon credits to offset them. So what they've come out and said, like, we're actually going to reinvest the money that we're going to use to purchase carbon credits to reduce our carbon emissions. So it is something to take into consideration. If you are working with any, carbon accountant or consultant, generally they will have vetted and scrutinized carbon offsetting projects before referring them to you. Something we do as well. Happy to kind of have that discussion separately, but it is certainly something to take into consideration. So I wanted to give an example of like NetNada carbon neutrality, because once you purchase or you calculate your carbon emissions and you offset them, then the next question, a very, very common question I get is, am I carbon neutral? Like, when can I say I'm carbon neutral? And the strength of a carbon neutral claim, just like any kind of sustainability claim, is around, 2 to 3 things. The first is the granularity of your analysis. Have you done a strong analysis? Have you covered, all of your scope 1, 2, and 3 emissions as required? Then it is the validity of your carbon offsets. Are they satisfying these considerations? And then the third one is like, has there been any third-party audit? Has there been, any signed attestation of good faith in terms of the carbon emissions calculated? So we help people with that all the time. Again, this isn't a carbon neutral seminar, but it is something that I always get asked, even like first kind of conversation, like, should we go carbon neutral? Like, is carbon, it's not the be all end all, but it is something that comes up in conversations very commonly. Again, wanted to keep this pretty short so we could open up discussion. Next time, as mentioned, 11th of September, we'll be doing another Carbon Accounting 101 session. We'll cover off what we touched on just then, but a bit shorter, and it will kind of leave us a bit of time to look at emissions boundaries, understanding what are my emissions and what are the emissions of my client. I'm sending a common question I had from a client is, we're paying for the logistics, or we're paying for the postage or the freight, but it's actually, whose emissions are there? Our emissions, or is it the client who receives the product? So that's emissions boundaries and understanding, and drawing a delineation between your organization and another one. Reduction strategies, like how do we reduce? What's possible at the moment? What's common? The popular certifications, everyone's generally heard, if you're in the certifications game, about Climate Active or CDP, Climate Disclosure Project's another one. And then the basic trends in disclosure, like, what am I, once I have my carbon account, am I going out and publicly stating these are my carbon emissions? Is it good? Is it bad? And I guess that would be the last thing I would kind of leave on before we get into questions, is around, some people can sometimes be worried that, we're scared, like, we're going to do our carbon account, what's it going to lead to? What are we going to state? And, or we're not sure if we're equipped to reduce them, and are we opening Pandora's box, so to speak? But there is no good or bad at the moment. And there's no good or bad at the moment because we're not at this level where there is really widespread disclosure and we can kind of compare apples to apples and get these kind of industry benchmarks. So the best thing you can do, and we were recently at a talk at Bloomberg, and they were saying the worst rating they give in terms of sustainability, in terms of carbon accounting, is non-disclosure. Doesn't matter what you disclose, but non-disclosure is the worst rating. So kind of having done this calculation, done your carbon account, and then kind of moving to the next stage is just a great place to start. yeah, like that's essentially. I'm gonna come back so I can kind of see everyone. Um, yeah,
Fantastic. Alex, I um, received one question privately in the chat, which, by the way, guys, you don't have to be uh, private if you don't want to. But um, the question was around collecting data. So they said, how and what specific data do we need to collect to accurately measure our scope one, two, and three emissions?
yeah, great. It's a good question. I think something we'll kind of maybe just have a bit of a pathway on the next seminar. But when we do our spend, what we will do when we work with any client is start off with the spend-based analysis, and we will export all of their expenses for the reporting period, which is a financial calendar year, and that will cover all of the required categories at its most basic level. Then the discussion is, okay, what are our next kind of emission sources or larger emission sources that we want to layer on top activity data? It's always electricity. It's always flights. Waste depends. If you just have a very, very small waste footprint in the office, then we wouldn't look at it. Or if you're a company who has a lot of fleet of vehicles, we may look at gathering more data beyond just your petrol expenditure. So it's very much deciding where we want to focus the initial attention. But with all of your account transactions, it will generally cover all the categories. And then at the minimum, we will require you to upload or we will acquire all of your utility data. Um, Other things as well that would always be done is a simple estimate at the most basic level of your employee commute to work or to office. And then everything I mentioned can become more granular. We do often do those individual employee surveys to understand the kilometers traveled to work to get a granular analysis. But yeah, I guess it's a how long's a piece of string is the answer. But at its most basic minimum requirements is all of your account transactions, your electricity data, flight data, and employee commute.
On your how long's piece of string, you're probably not gonna love this one because it's just as much on a how long's piece of string. But another question was, what assumptions and estimates are okay to be made, and what are not?
Yeah, it's another question like that. The assumptions and estimates we need to have at least coverage across all of those emission categories from, we can't make just estimates on your account transactions and your expense based. So on the spend based, we wouldn't be doing an estimate. But when it comes to activity data, you know, it's better to think about being open and transparent. Wherever we've used an estimate, and this is very similar. The first example that comes to mind is that when you're doing a climate active certification, the Australian government certification, you do not need to use their calculators that they have in there, but you do need to be transparent with the calculator and the estimate that you've used and just provide your working. Now, we're not suggesting that we just kind of make up and have a guess. Any good service or consultant is going to guide you towards industry accepted calculators, but using an estimate for things such as your waste or your employee commute is certainly accepted. In other areas where the data is available and it's not going to cost us too much time or money to collect, then we shouldn't be using estimates.
Yeah, great point. I think I just add to that. You had a slide before of like somebody lifting weights,
Yeah.
and it's kind of the same mechanism but different. You know those what the way scales, and I always think of this as like a a time and outcome versus a time and effort versus outcome, and you got to make sometimes those decisions on, um, how much effort is it worth going to say survey every single person about, I don't know, how much waste they think they generate each day when you don't have the data itself. And there are some really good industry benchmarks and aggregates that have been made from, some of the leading research organizations and universities in Australia alone and all over the world. So sometimes using those aggregated estimates is a really good thing and a really efficient thing. Question in the chat from Fiona is, what is the general timeline for carbon emissions assessment for a small to medium sized business?
Yeah. For a small to medium sized business, and I can only really speak for NetNada, but we generally look to have it done within 2 weeks to a month. Now, that's analysis on our end. In terms of requirements on the business end, it's generally 30 minutes to an hour and a half over those 2 weeks to a month. So it's quite small, and we're in the business of making that timeline and that effort as simple as possible. So yeah, that's generally where it sits. When it can blow out, when it can get a bit more complicated, is if we're going for more bespoke certifications or mandatory reporting requirements. But in terms of getting just the carbon emissions assessment done aligned with GHG protocols, yeah, we're looking at around 2 weeks to a month, pending urgency.
Yeah. Good point. I think just adding as well to that is you can always improve, as Alex was talking about, and I think his example of big companies who've been doing this for 5+ years. If you compare their sustainability report from 5 years ago to now, it's almost like chalk and cheese. So yeah, it's certainly like a process of iterative improvement post that first month.
Yeah, definitely.
Cool.
Yeah, exactly. And if you did it 8 years ago, there would have been a lot of manual work, a lot of time in spreadsheets, I'm sure.
Yeah, for sure. Thanks for that question, Fiona. Any other questions from anyone here? You can take yourself off mute if you'd like and just ask. No worries. If there are any questions that do pop up or come to you over the day, please feel free to reach out to Alex or myself. But yeah, I hope everyone got lots out of that session. I think Alex, fantastic job. Thank you very much for walking everyone through that. And I think yeah, all of your experience dealing with lots of our clients at NetNada, and understanding the pain points for people understanding, their first step into carbon accounting definitely showed there. So yeah, thanks for the session.
No
And if
worries.
there's no more questions, we'll let you all go. I hope you enjoy your lunch.
Yep. Have a great lunch, everyone. We'll send over the recording in a week. Thank you.
Fantastic. Thanks, guys.